A $300,000 difference. Not from one person taking more risk, not from one person earning more money, but from a tax bill that arrives every single quarter without anyone ever warning you it would. Let's set up the scenario properly so everything stays fair. Two guys, both 30 years old, both earning $75,000 a year, same tax bracket, same goal. Build real wealth in a regular brokerage account and retire comfortably. The only thing separating them is their strategy. Alex goes the dividend route, spreading $1,000 a month across Dividend Aristocrats, high-yield ETFs, and REITs, pulling in roughly a 4% average yield. His co-workers love hearing about it. Quarterly cash hits his account. It feels like a system that's already working. Meanwhile, David buys one single fund every month, a total market index fund, and does absolutely nothing else. No research, no stock picking, no dividend tracking. His friends at dinner parties have never once asked him about his investment approach. It sounds boring because it is boring. But here's the thing about boring, and this is what nobody on social media wants to admit: boring has been quietly destroying exciting for decades. For the first several years, Alex looks like the obvious winner. By year 5 he's pulling in close to $2,800 annually in dividends without lifting a finger. Cash is flowing in every quarter like clockwork. David has a balance that keeps climbing on a screen, but nothing arrives. No notifications, no checks, no confirmation the strategy is doing anything at all. On every emotional scoreboard you can imagine, Alex is ahead. But there's a concept that almost nobody in the dividend community ever explains, and it changes everything. When a company pays you a dividend, the share price drops by exactly that amount on the ex-dividend date. A $100 stock paying a $2 dividend opens the next morning at $98. You didn't receive new money. You moved your own money from one column to another and then handed a portion of it to the IRS. This isn't a hot take. Finance academics established this in 1961. Your passive income feed just forgot to include that chapter. Now add the tax drag on top of that. Every single dividend Alex receives gets taxed in the year it's paid, even if he immediately reinvests it. Qualified dividends get taxed at long-term capital gains rates. But REITs and many high-yield ETFs generate non-qualified dividends, which get taxed at ordinary income rates, the same rate as your paycheck, all the way up to 37%. Over 30 years, that annual tax drag of just 0.5% to 1% sounds trivial. It is absolutely not trivial. On a 30-year compounding window, a 1% annual drag translates to roughly $300,000 in lost wealth. Not $30,000. $300,000. And David sitting on his index fund. He's paid almost nothing in taxes during accumulation because index funds barely generate taxable distributions. $300,000 in lost compounding, and Alex never felt it happening because dividends kept arriving and his balance kept rising. The math was bleeding out in slow motion while the emotional scoreboard kept flashing green. Then there's the sector problem nobody talks about. Dividend-heavy portfolios are loaded with financials, utilities, energy, and consumer staples. They systematically avoid technology. The exact sector that has driven the majority of market returns over the last 2 decades. Alex essentially opted out of the fastest compounding part of the market without realizing that's what he was doing. And yield chasing makes it worse. At an AMP, T slashed its dividend nearly in half in 2022. General Electric cut its dividend from over $1 per share down to literally a penny. Wells Fargo dropped its dividend by 80% in 2020. In every single one of those cases, the cut came with a collapsing share price. Investors lost both the income and the capital simultaneously. The dividend felt reliable right up until the moment it wasn't. By year 30, the scoreboard looks like this. David's index fund, approximately $1,780,000. Alex's dividend portfolio, approximately $1,410,000. A gap of $370,000. Alex also paid roughly $48,000 in cumulative dividend taxes over 3 decades. David paid around $3,000. But here's where it gets even more dramatic: at death. If David leaves his index fund to his heirs, they receive it with a stepped-up cost basis. All those decades of capital gain simply disappear from a tax standpoint. His heirs can sell the entire portfolio immediately and owe zero in federal capital gains tax. Alex's portfolio got taxed every single year of its life. There is no equivalent recovery at inheritance. Now, to be completely honest, because one-sided arguments are the whole problem with this conversation, dividend stocks genuinely make sense in specific situations. Inside a Roth IRA or 401k, the annual tax drag vanishes completely. Dividends in a Roth are never taxed. That changes the entire calculation. For retirees who genuinely struggle with selling shares to fund living expenses, the psychological certainty of a dividend check has real behavioral value. And dividend growth stocks specifically, companies that have raised dividends for 25 or more consecutive years, have delivered solid returns at lower volatility historically. As a complement to a core index position, they're defensible. The key word is complement, not replacement. So here's the actual playbook that the math supports. During your accumulation years, build your core wealth in low-cost index funds. Lower taxes, lower fees, broader diversification, higher historical returns, and complete control over when you realize gains. Step 2. If you want dividend exposure for psychological reasons, hold it inside tax-advantaged accounts where the drag disappears. Placing dividend stocks in a taxable brokerage account when you have Roth IRA space available is one of the most expensive mistakes a retail investor can make. And step 3. As you approach retirement within 5 to 10 years of stopping work, shift a portion toward dividend growth stocks for income stability, as a complement to your index core, not a substitution for it. The real trap was never dividend stocks themselves. The trap was being sold passive income as the goal when total return is the actual goal. Every dividend dollar you collected this year came with a tax bill attached and a share price reduction attached. It was never free money. It was always your own capital being handed back to you on the IRS's schedule. For most people, building wealth over a 20-plus year horizon in a taxable account, index funds win. Not barely. By a margin that, when you finally see the real math, you cannot unsee.